Have you just found investing and don't know where to begin? Don't worry. I'm going to share my 5 favorite investment steps for beginners. These are the easiest things to do which will get you started on the right foot. What is an investment? Speculation is defined as the purchase of anything of significant worth in order to increase cash flow. While most people connect speculation with stocks, bonds, and other financial instruments, it also includes real estate, fine art, collectibles, and even wine. Contributing entails a lot of risks, but for a huge number of financial backers all across the world, those risks have repeatedly paid off. While gambling is more likely to end in a loss, a well-planned investment strategy may help you achieve long-term goals like enough retirement funds, homeownership, or a debt-free education for your children. Continue to study and grow more about businesses, how they operate, and how you can contribute even if it's only a small amount right now. Make smart investments. You're earning too little and saving too much, but you're putting it all into safe investments like your bank's standard investment account. Isn't that sufficient? Wrong. You'll need to take on some risk in order to establish a large portfolio, which means you'll need to invest in security. So, how would you figure out what amount of transparency is right for you? Assess your existing circumstances first. The CFA Institute recommends that investors create a venture strategy description. First, choose your return and hazard destinations. Examine all of the aspects that affect your financial life, including family pay, time constraints, charge considerations, income or liquidity requirements, and any other factors that are specific to you. Then, choose the appropriate resource section for you. Unless you are confident in your ability to handle this on your own, you should consult with a financial advisor. This assignment should be based on your description of your speculating approach. Your project will very certainly have a mix of money, set compensation, values, and optional guesses. Risk-averse investors should keep in mind that portfolios require at least some value openness to protect against expansion. Similarly, because they have more time on their hands, more young financial supporters may afford to allocate a larger portion of their portfolios to values than more seasoned financial backers. Start investing early in life. Musings about contributing right on time for a safe future are regularly ignored, particularly by the recently utilized since carpe diem is by all accounts the expression to satisfy. In any case, given the unpredictable economic situations and the unstable worldwide economy, contributing ahead of schedule for a steady future is shrewd. Your 20s are the years where you have nearly fewer liabilities and more discretionary cash flow. The first stage is to determine your financial goals and educate yourself on various investing possibilities such as mutual funds, stocks, and fixed deposits (FDs). The next step is to select the solutions that best fulfill your venture's needs, both now and in the future. Having more time on your site implies you'll be able to hunt down speculations with higher payouts over a longer period of time. Early contributions allow you to explore new pathways for your investments, adjusting and refocusing your portfolio in response to your changing lifestyle and financial goals. Furthermore, the sooner you begin, the less you will have to contribute later, as amassing cash takes time when creating a substantial corpus. Here's some advice for first-time investors, and some common financial mistakes to avoid. Almost every week, you'll hear about a stock market expert's nightmare. Learn more about the history of investing by reading investment literature. Avoid gambling for fast short-term gains. Because investing is such a long-term commitment, many new investors expect to make large profits. While it is true that investing giants such as Warren Buffett accomplish this, a little long-term investment may generate long-term riches from a firm. Don't be surprised by profit statements. While it's true that earnings statements can be tough to understand, removing firms from your portfolio because you don't comprehend them is way too risky. Avoid these investment mistakes if you're a beginner. Investing in young firms while they are still forming is risky. Tiny enterprises with limited reports and operating data are speculative. If you just have one or two credible sources of data, it is safer and preferable to undertake your own investigation rather than solely rely on others. When it comes to investing, don't forget to consider your risk tolerance. Investors should pick more cautious investing alternatives if their risk tolerance does not match their investment ability. Keep your first investment to a minimum. Don't put all of your eggs in one basket. Make a plan for asset allocation. A properly chosen asset assignment philosophy in conjunction with the financial organizing process is the approach for bringing you closer to establishing a good financial foundation. You may be able to limit the consequences of unsteadiness while increasing your prospects of high returns in the long run by dividing your investable wealth amongst asset types that don't respond to market shocks in this way. Another important aspect of the asset assignment plan that individuals sometimes overlook is risk desiring. While some may see it as a chance to make money by investing in high-risk asset classes, others may see it as a risk of losing money. For example, you may have put your money into a terrific endeavor thing after getting duped by beautiful statements that are obvious. In any case, you're unlikely to have completely grasped the implications of investing in such a vehicle. Promise that you will only invest in products that fit your risk profile and that you will go above and above to fully comprehend the risks you are taking. How to build a solid financial foundation. More solid foundations are required for strong designs. Unfortunately, when it comes to our financial future, the vast majority of us neglect this basic, yet important, reality. Redesigning one's resources and constructing the robust framework that may assist in accomplishing one's financial goals and ambitions is critical. In the present financial crisis, the relevance of a proactive system has been highlighted.
Here are several major developments that might assist you in establishing a solid financial foundation. The fundamental advance is to properly express your objectives, as you will be able to show up at your real if you know what it is. Anyway, we all have dreams, the only difference is that we only write them down sometimes. Whether there are a couple of us or not, there isn't a lot of translating them into unambiguous numbers. Describing a goal is crucial as it clearly influences closing the course you choose to achieve. For instance, expecting you will probably set something to the side for a vehicle a year sometime later, you ought to be more moderate in your procedure as a result of the absence of time. In any case, you're making courses of action for your retirement, which is 25 years away. You can tolerate putting assets into asset classes like worth. Finally, keep the time skyline in mind when planning pleasant travel to your objections. This means that the sooner you need your money, the better it is to invest it in high liquidity investments. For example, if you only have 7 days to prepare a true test and are limited by the amount of money available in the country, you'll need everything but a good hypothesis to achieve the best results. If you like this video, please don't forget to give it a thumbs up, and subscribe to our channel, and hit the bell icon to stay up to date.